Welcome to the Asset Coach and Tax Strategist YouTube channel. If you're a subscriber, thanks so much for subscribing. If you're a first-time viewer, thank you for spending your time here with us. If you like our content, please give us a thumbs up. For you new folks, Asset Coach Tax Strategist YouTube channel is based on the book Economic Termites. This is a book that I wrote a few years ago talking about taxes, inflation, time, laws and regulations. Also, I wrote a second book called Farming Assets. Those two books is really what this whole channel is about, addressing those situations and how they affect you and I in our ability to grow our wealth. So as an asset coach and tax strategist, my name is Robert Wolf. I am the CEO and founder of Terra Firma Business and Financial Consultants and its affiliates. We have a bunch of companies that we've built out this ecosystem surrounding the basis of what we talk about on this YouTube channel. So if you're not a subscriber, hit that subscribe button. We drop episodes every Thursday. Again, if you are, thanks so much. And let's get into this next episode. So we're going to continue our series here as we're talking about Robert Kiyosaki, Rich Dad, Poor Dad. Our first episode, we really started talking about what's going on with the U.S. debt and the resources in Venezuela and Greenland. What's happening? And so last episode we talked about, okay, so if Robert Kiyosaki said that if he had to start all over again, what would he focus on? Okay. And so we spent last episode talking about that. So today, what we want to talk about is more of that, but we're going to intertwine Warren Buffett into this conversation as well, because Robert Kiyosaki has built a business. So here's what he talked about in quick and summary. So if he lost everything, what would he do? Well, the first thing he would do is he would basically learn the skill of real assets, real estate business, and have hard assets. Those are the things that he would focus on. Then he would learn the skill of sales. And that terminology translates today into communication, being able to communicate and what that means. And then understanding his skill number 3, understanding the use of debt as a tool, but also still being very mindful that it is still debt. Okay. But how do we leverage this tool to help build this wealth? Okay, so that is kind of his what I would do. Now, moving forward into today's conversation, what's that mean for you and I today? Well, let's think about, so what did Robert Kiyosaki do? He created a business. His business, he wrote a book called Rich Dad, Poor Dad, and he continued to build this Rich Dad series. And he got his CPA, he's got his real estate people, his attorney, he got all these other people that he used in his team that also wrote books to talk about and support about what he did. And so he built a business. What was one of the skills? Business. Okay. And in this process, he was investing in real estate. That was the second one. And as these two businesses were cash flowing and building cash, what was he doing? He's taking that cash flow and buying hard assets. Okay, so this is very important. Now let's translate to, well, what about Warren Buffett, Bob? Where you were talking about Warren Buffett. Well, Warren Buffett, he took over a business. His business was investing, understanding the value of a business, the value of a business and what that means. Okay, so he ended up buying Berkshire Hathaway. You know, by the way, Berkshire Hathaway is essentially an insurance company. It's a conglomerate, but really the cash flow to be what it is from insurance. But it didn't start off that way. It was a textile mill that failed because that industry failed. The U.S. got rid of it, right? It all went overseas. So Berkshire Hathaway still had the business, still had the value of the time and length of Berkshire Hathaway being in business and the value of credit. And so what Warren Buffett did was shifted and what Berkshire Hathaway from textiles to buying and investing in businesses, and what he started to do today. Well, 6 decades ago. So what happened? Well, he started off as an investor. And so that's what he did. He'd buy into good companies, understanding good companies that were dominant, that had good management. He understood the value of communication and management and product and dominance of a product. And so he would buy shares, and today Berkshire Hathaway, I think, earns like $1 billion in dividends. Walks in January, they're making $1 billion already in dividends. Okay. Now, what he started doing, he took that to the next level. And then 1967, when he understood the value of insurance companies, National Indemnity was the first insurance company Berkshire Hathaway bought. He understood that there's this thing called insurance flow. This is his terminology, and he uses this terminology every year in the shareholder meetings. What's insurance flow? Well, when you look at property and casualty insurance, okay, property and casualty meaning home and auto and business. They're annual contracts. Okay. And you pay premium, you and I as consumers, as the insured, we pay premium for an exchange of financial risk transfer. If something happens, meaning we have to file a claim, the insurance company would pay that claim, make us financially whole again. And there's a cost to that. So it's a form of debt, right? It's a form of debt. There's a financial relationship. There's an exchange in this agreement. Okay. And so when we send money to them and we have a claim, well, the business of insurance has to pay for the expenses, right? The overhead and staff and all that kind of stuff, the expense of business. But when there's money left over, they put it into what they call reserves. And those reserves are there to pay for claims. But when they're pooling all these dollars, who gets into an accident every year? Right? Please do not raise your hand. Right? Not everybody gets in an accident. Not everybody's house gets burnt down or anything like that, and it sucks at it when it does. I know of people who've lost their houses to fire, and it sucks. And they find out the value of their insurance or how they're underinsured in that experience because we don't want to overpay premium. We don't want to pay so much because when's my house going to burn down until it does? But that's that exchange of financial value. Okay. Now, here's the thing. When the insurance company pools all these dollars together, they pay for their cost of doing business, they put the money into reserves, they invest those reserves. It's called investment income. Okay. And if you have a claim, you file a claim, they pay for that claim out of the reserves, the insurance company keeps that investment income, that insurance float. If there's no claim, they keep the reserves and the investment income. Okay. That's a cash flow. That's a cash cow. So Warren Buffett started using that to help build and buy other businesses. Okay. And so that's how Berkshire Hathaway started buying others' business. Hey, if you want to go invest in the S&P 500, why? Go invest in Berkshire Hathaway. The S&P 500 is driven by the top 7, 10 companies in the S&P 500. They call them the Mag 7, Magnificent 7, right? That's really the other 493 are kind of dragging, right? But those are the 500 largest companies. But what Warren Buffett did in Berkshire Hathaway kind of created his own mutual fund. And he's outpaced the S&P 500 for 20 years, 2 decades. Why wouldn't you just do that? Invest in Berkshire Hathaway. I don't know. Anyways, but this isn't investment advice. I don't know you. This is just education, right? I'm not your financial advisor. I'm not giving you investment advice here. We're just talking about educationally what Warren Buffett had created, right? So it makes a lot of sense when you look at that and go, oh, okay, that makes sense. So what he started doing, he started buying good companies. And then in this value, in this insurance float, he started understanding the value of hard assets because in 2008, when we had the great financial crisis, what happened? The government, laws and regulations came in and said there's this too big to fail for banks because if a large bank crumbles, it could ruin the financial structure globally because we were in globalization. So what would happen? Well, they had this brilliant, oh my goodness, when the government creates stuff, we know, stand back. It's awe-inspiring. Sarcasm, right? So they created laws and regulations and they went knocking on these banks and said, hey, based on you too big to fail, you have to have a certain amount of money sitting over here in cash. Which makes sense, right? So what Warren Buffett do? Well, they knocked on Berkshire Hathaway's door, who, by the way, bailed out Goldman Sachs. And so they knock on his door and they're like, "Hey, Warren, sorry, buddy. Based on the calculations, you're a financial institution. You're an insurance company. By the way, Warren Buffett they own 10 insurance companies, so they definitely understood the value of insurance float. You're gonna have to change your capitalization values." And so what would Warren Buffett do? All right, well, thanks, appreciate that. And so him and the team got together, and then they go buy a railroad company. Why? Hard assets. Each of the cars are a physical property hard asset. And there's tax benefits that they also received from each of those. And it brought his value down, but he didn't lose value. He transferred that value from cash to hard assets. That's what business does. So when Robert Kiyosaki is talking about real estate, business, hard assets, that's what he's talking about. This is why we use cash value life insurance, because all these insurance companies own hard assets. Most downtown towers are owned by insurance companies. You see bank names, but they're also insurance companies. And the insurance companies insure those businesses. Okay. They're their own cash cow. That's why we use cash value life insurance. As a consumer, we're not an insurance company. So how do we leverage the value and the benefit of an insurance company? Well, you seek where you get the best value. In that cash, that asset in cash value life insurance, you have access to that liquidity as well. So you can use that to your benefit. Okay. So this is why we have the asset buddy system. But essentially, when you look at Warren Buffett and how he had structured Berkshire Hathaway, looking at good businesses, real estate, right, and hard assets, and creating this flow of cash. Cash flow is the king. And that's what Robert Kiyosaki did. That's why he likes real estate. That's why he likes business. And he takes that money and puts it into hard assets. Okay. So the use of the tool of debt and that leverage allows you to springboard into those assets. So what if you're buying, for example, if you're buying real estate, and let's say I have a property and I have $500,000 of equity in my property that I have access to, and I were to borrow it out, what would I do? Well, you can go buy a business, a good business that's cash flowing. Okay. Or you can go buy real estate. Now, let's say you buy real estate and it's not cash flowing based on the numbers, but man, this is a good location, what they're doing in this area and revitalizing and build and growth and, people moving into this area. Man, this real estate's really good, but I'm not going to cash flow, not right away. But I may get some tax benefits. I may get some appreciable value. Oh, because cash flow turns into taxable income. So if I can use some of the tax benefits, if I can use some of the appreciation value and not have to pay tax on it, that's a form of cash flow. Okay? So understanding how to use each asset in your overall plan allows your value to increase, but your liabilities did decrease, and taxes are a liability. It's something you owe. Okay? So that's very, very important, which our government doesn't understand on their own because they get to print money. You and I do not. So we have to go buy assets that print money. And that's cash flow. But that cash flow has a debt that is owed, meaning taxes. So we have to structure our plan to minimize our wealth and our assets to minimize that debt that we owe, or that liability we owe in taxes. So we have more value and wealth. That's the basis of it. That is the basis of it. So understanding this process is very important. So what we're going to do now is in our next episode, we're going to spend a little more time and I'm going to dive into more of what Robert Kiyosaki has been communicating about what's going on with Venezuela, what's going on with some of the decisions that the United States is making, because I think this is extremely important to understand the mindset. Okay. And this is what is happening in the elite level of conversation. So Robert Kiyosaki just has done a very good job since Rich Dad Poor Dad to now to explain the mindset of what's going on and how, and he's been very consistent, which is why I want to use his information. So remember, no investment advice here. We're just giving you education, informational purpose information. So you got to make your own decisions on and hire your own team to figure out what you're going to do with your dollars. But what's happening and what these guys are doing, they're not hiding under a rock. They're pretty public. It's just a matter of up to you to decide, do you want to mimic some of this stuff, right? It's up to you and I. That's why God gave each of us a brain and the ability to do this. Okay. So we got to learn these skills. We got to be prepared, be valuable in this next economy that's coming up. Thanks so much for joining. Make it a great day.